Hello and welcome. You're watching All About Your Company here on ET Now. I'm Harsh Saita. This is a show where we follow the roots of investing. We go back to what the greats of investing say. You have to understand the business before you invest, and that's what we try to do on this show. Today we're going to talk about Vascon Engineering. It's a 1100 crore market cap company, but there are three big changes that have happened over the last 6 months. The first big change is the fact that they've gotten an MOU signed with Adani Group. And this is an MOU which is going to likely comprise 30% of their revenue very, very shortly. They haven't given a timeline. We will ask them for the timeline as well as for the margin on this MOU and the business that they're going to get from the Adani Group. The second one is the order book, the kind of pipeline that there is, whether the outlook looks good for FY26. The guidance is 1,500 to 2,000 crore of order book accretion. They've actually done only 400 crore in H1. Can that at all change? Can they actually clock that 1,500 to 2,000 crore order book? If so, it'll be impressive. The third piece is real estate sales, especially on the Orchid project. There has been a lag there, which is what is causing a headwind with regard to the numbers for H1 as well as the numbers in the past. That has been a little bit of a pain point. Can that change is the question. Is there a surprise on the EPC front? They've guided for 1,200 crore of EPC revenue in FY26. They've done very well in H1. 580 crore is what they've done on the EPC business in H1. They generally do 40% in H1, 60% in H2 because of seasonality. If that is so, there could be upside to that EPC business. Margins, 10% in FY26 is the guidance. Can they do it? 10 to 12% in fact is the guidance. Can they even do 10? I'd be very happy because H1 they haven't done that. The sixth piece is trade receivables as well as inventory. Comprises around 70% of top line. Is that general course of business, or can we expect that to improve going forward? Mind you, a large part locked in working capital is always a problem. Can the steady state business clock 20% growth? With all of these levers available, you would reckon that they can do that. But you want to wait and watch and ask the management whether they can actually do that and a 10% to 12% kind of margin. What's giving them that kind of comfort to guide for these things? Let's quickly now talk straight up about what the company does. And it's incorporated in 1986. It's Pune headquartered. It's largely predominantly in Maharashtra. 40% of orders, etc., that it does is Maharashtra based. It's a diversified EPC player and it's a real estate developer as well. These are its two lines of business. Those two lines reflecting on your screen. Let's talk about EPC first. EPC is engineering, procurement as well as construction. So from design stage all the way to construction stage, they do all of it, and therefore, as the name would suggest, they do it for hospitals, colleges, buildings, office spaces. They do it for the whole hog, right? Including housing, IT parks, metro. They do all of this, and these are all turnkey civil works that they engage in. In terms of capacity, they have around 8 million square feet capacity annually, and they're operating at a 90% capacity utilization. Expected to do around 20 crore of capex, which should add to the capacity utilization that they currently have, as well as the capacity. In terms of geography, I did mention 40% is Maharashtra. The balance is Bihar, Tamil Nadu, and Goa. Smaller in relation to Maharashtra, which is 43%. Let's talk about now the order book. 75% of the order book government and around 25% is private. That also is the other problem with regard to receivables. Can that at all change is the question that we'll ask. Some really marquee clients that they work with, they are on your screen. There are quite a few that they work with. In terms of real estate as well, they entered the business in 1989, so maybe 3-4 years after incorporation. They've launched several projects, but these are the current or the recent launches that they have. Also, in terms of upcoming projects, there's one coming up in Powai in Mumbai, which is on your screen. In terms of order book tilt, now let's talk a little bit about this. 2,800 crore is the order book. They've done 1,077 crore of revenue in FY25, so it's around 2.6 to 2.8 times book to bill. External EPC, which is 2,400 crore of the order book, and the balance, which is internal real estate, is around 389 crore rupees of its order book. Now, in terms of the Adani engagement, and this is critical, they've signed a 5-year MOU with Adani Infra. The deal starts with 3 projects coming out of Mumbai alone, and the turnover, the targeted turnover is 30% of Vascon's yearly sales. through Adani projects. Now that is significant. Given that it trades at around 1x sales in terms of its valuation, this could be huge because it could add significantly to the top line. Now let's talk about the metrics like we always do. Break it down, give you a 3 to 4 year view on what the company has done. Now this is the 3-year CAGR in terms of top line, 18% CAGR, but you can see the choppiness. There's been one non-core business which they've diversified, which has contributed to some extent to this choppiness. But nonetheless, from here on, there's expected to be more stability. 20% growth on the EPC business is what is likely this year, is what they've guided for, and they're likely to achieve it. Let's look at the H1 performance. Again, the H1 performance is looking a tad shy. You look at the way in which H1 has played out, around 447 crore of top line revenue, EBITDA of just 29 crore. The margins have sunk to sub 7%. Can that change? And that can only change if the real estate business picks up. So you want to wait and watch as to whether that can happen or not. You can see those numbers of H1 on your screen. You look at now the margins over the last 3 to 4 years. The margins have fluctuated quite a bit, and that's because of the real estate business. If that were to change, the margins could well change in terms of the picture, and that's the only way they can get to the 10% margin number. Of course, we'll take thoughts of the management on this front, but this is crucial. The margin recovery is going to be crucial. If at all they can hit that 10-12% margin, it could well be a change for the business. Now let's talk about the order book, especially the book-to-bill ratio. This is the second metric that we'll look at, because that's for infra companies. This is a very, very important component. Let's pull that up. In terms of book-to-bill, it's traditionally always been between 2.5 and 4.5. In 1 year, it sank to 2, which is FY23, but thereafter, the book-to-bill has picked up. It's currently sitting at around 2.6 times sales. So this book-to-bill ratio is nothing but your order book to your revenue. So your revenue visibility for these many years is clean, is what you understand from this number. So 2.5 years of revenue visibility, at least for the moment, based on FY25 revenue, is what we can see. Now they are gunning for another 100 crore of orders, so that order win rate has to go up. We'll try and understand that as well from the management. Let's talk about the balance sheet. Now this is relatively where things are much better. You're looking at a decent equity base of around 220 crore, and then you have around 900 crore of other equity. So you've got around 1100 crore. The stock is trading at 1-time price to book when you're looking at the book value. The borrowing number is around 270 crore, which looks steep, but you look at against that borrowing number, you look at the receivables, you look at the inventory, and you look at the cash. In fact, only if you offset that, it's in a net cash position. So that's a positive, that the borrowing number is not as bad as some of the other working capital requirements of the company is concerned. So you want to see whether working capital requirements of the company remain elevated or not. Let's talk about cash flow now. This is where it starts getting tricky, because your cash flow from operations have been extremely muted, at least the last 2 years. It's been a tough couple of years. They've been able to sustain with healthy cash flows only because of the fact that they've sold their non-core business. So FY25, they had 100 crore of surplus cash because of that. EBITDA, also, if you're looking at it, cash flow to EBITDA is not looking too healthy. While it was very good in FY23, FY24 and FY25, that number has sunk. And that's where some part of the problem lies. Let's now look at return ratios. The return ratios have gone from negative to positive 8%. And it's been very, very choppy where the return ratios are concerned. In fact, FY23 was an 11% return ratio. Again, not looking good. We've given this a neutral only from a perspective that there could be positive upside going forward, and FY25 was a bad year. But single-digit return ratios, not looking good. Now let's talk about the shareholding pattern. Promoters own 31%, so not really impressive. It's a small company, so very less interest from FIIs and DIIs. The public holds the balance. The number of shareholders have spiked really sharply. None of those looking too good. Promoter holding 30%, okay. But outside of that, none of the other things giving any comfort. You look at the number of shareholders which have increased. They've gone from 40,000 in FY22 to 97,000 in September 2025. The number of shareholders has just gone up dramatically. Let's talk about now the management guidance that has come through and try and extrapolate the numbers going forward. The revenue guidance of 20% on EPC means that you'll do around 1,300 crore of top line. The 10% EBITDA margin will mean around 129 crore of EBITDA, and thereafter that lands up with a profit of around 75 crore, assuming depreciation and interest of around 30 crore odd. So that's how we've run the math, and that's how the number really stacks up. This is how valuations stack up. 17 times is the rough 3 to 4 year average in terms of price to earnings versus the 11 times 1 year forward price to earnings that it trades at. That's not the average P, that's the 1 year forward, which is FY27 P, which we just extrapolated based on management guidance. You want to keep that in mind. So all of that looks okay. Valuation wise, it looks fine. Now we've run through all of the metrics. What we will do is we will have a conversation with the management. Siddharth, Vasudevan, Moorthy, who is the managing director at Vascon Engineers, will join us on the other side of this very short break. Stay with us. Welcome back. We're talking about Vascon Engineers. We've tried to analyze all of the data with regard to Vascon. Let's pull up the stock price. Absolutely flat in trade today, at least, but 1100 crore in terms of market cap, just to kind of refresh. Let's go across. We have Siddharth joining us, and he's the managing director at Vascon Engineers. Siddharth, great having you. Let me first start off by understanding how large is this Adani opportunity, the MOU that you've signed with the Adani Infra, rather that entity or the Adani Group. How large is the opportunity size for you, and how quickly do you get to that 30% number? And at that point, what will your revenue be? Give us color on all of these parameters.
Yeah, sure. Thank you for having me, Harsh. So the Adani MOU is an early stage MOU, which means that we are actually liaisoning with the Adani Group to do work for 3 projects in Mumbai. It's at a very early stage, and this, I mean, these are large projects, so we are quite hopeful that we'll be able to start work with them within the next year or so.
So you start work within the next year. At that point, what should your revenue be? You've roughly guided for 20% growth both years, which should take your revenue to around 1500 odd crore. So will 20% of 1500 crore come from the Adani Group? Is that the way to think of it?
No, we have not. We have not calculated any revenue from the Adani Group into our projections at this point of time, because we felt that it will only be prudent to do so when we actually start work on site, and therefore the current projections that we are giving you don't. They only are calculated on the basis of the work already in hand.
Okay. But you're still confident of Adani Group contributing 30% of your revenue?
So what we are saying is that we would like to only do work with them up to an extent of 30%, which is what even they are comfortable with, which then gives us the flexibility to work with other clients as well. And like in the private space, we are only working with marquee clients such as Capgemini, Vedanta, guys like those.
Yeah, right.
So we want to continue with that. We don't want to be a single company focused organization. So we'd like to spread our wings along with the Adani Group as well.
Sure, understood. And is this going to be margin accretive for you? You're going to help them with real estate development. Now, real estate as a business for you, there's been a bit of drag on that part of the business. Talk to us about what's playing out there. Have recovery started coming in? Have sales started materializing? Is it still slow, especially Orchid's project at Santa Cruz? And how does Adani Group stack up in terms of margins for you versus your typical real estate business?
Yeah, so Adani is going to be an EPC, EPC business. It will not come into our real estate order book at all. So we are focusing on the execution of the projects that they have in hand already. So so I don't think it's a fair comparison to our real estate project. But since you brought up our real estate, I'd like to point out to you that we've already launched Orchid, which is in Santa Cruz. We have a second project in Santa Cruz itself, which is Prakash, which we intend to launch by by the end of this financial year. And the third
Sure.
one that we have is Powai, which is not a redevelopment, but it's our own project over there, where again we anticipate a top line of around 550 crores to come in from there.
Perfect. Okay. What about and how quickly does it materialize? Because it's obviously chunky revenue, and you found it a little difficult to liquidate inventory, I gather. Talk to us about whether that how some of those trends are playing out at this point with your real estate business.
No, sure. So, we've sold a decent amount in orchids already. The challenge over here for us has been that from the accounting method point of view, we've been asked to follow completion method. So all the sales
Sure.
that we have done through the lifespan of the project only gets recognized when we get our completion certificate. This is also one of the reasons, like you pointed out, our inventory and those numbers look high, but in actuality, those are all sales that have happened, which we need to
So,
then get into the book at some
sorry,
point of time.
I'm sorry for interrupting. So when does that translate? So when does the completion certificate come through?
Yeah, so like for different projects there are different timelines, but if we talk
Sure.
specifically for orchids, we've already built above plinth. So we are looking to finish this project in the next 15 months or so.
Okay, 10%
Yeah.
to 12% margin. How confident are you to get there? Because there is obviously competition coming in within EPC and real estate. There's maybe some time before those some of those projects convert or complete. So, how confident are you 10 to 12% margin in FY26?
Yeah, so I'll give you our reasons behind it because we've strategically thought of these numbers. In the real estate business, we're playing in a zone where we don't have structured players competing against us. If you look at the kind of projects we're doing in Mumbai, we are not competing with the big guys doing large projects of 1 million, 2 million square feet. We're looking at projects which are sub 20,000 square meter approvals by law. And therefore, you're playing a quick in, quick out kind of game. And we've been competing against players who are not structured as us. In all the real estate projects, the redevelopment projects that we've built so far, we've always been in the top two, top three. Uh, so we've been very picky on that. On the EPC business front as well, as much as we value our top lines, we value bottom lines as well. And that is the
Sure.
reason we've been, we've not been going after every private developer that's come our way. We've been very selective in who we want to work with. We like to ensure to to the best of our abilities that our interests in the project in terms of cash flows, in terms of payments, all of these are secured. And it's only then that we like to get into projects. So, we've been very strategically picking up hospital projects as well because these are projects,
Right.
public sensitive projects, and therefore the uh, we see them where we are able to execute them on time. The client pays us well, and that's the reason that we've focused specifically on doing hospitals. We have around 6 to 7 hospitals that we're currently doing across the country as well. So
Right.
that's how it is.
Okay. Confident of that 10% EBITDA margin. Siddharth, it's been a pleasure speaking. Thank you so much for coming in and speaking with us. Of course, H1 was a bit tough, but a full year, they're able to deliver. That's a big positive. We'll wait and watch as to whether that plays out, but completely out of time on this edition of AAYC. Thanks so much for joining us today on ET Now.